Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. As you all know, I'm Samantha Parinello, and I am your host of the show, and I'm here with my resident guest expert, Chris Parinello. Welcome back.
Thank you. Hello, everybody.
So as we mentioned, we had that awesome interview with John Chang this week, and I really just wanted to find out how you felt it went.
No, I think it couldn't have gone better. He really answered, all of our questions. You started out, very strong with asking him all about politics and how this is going to affect everything. I think he wasn't expecting to start out like that.
Said in his words were like, whoa, like you're starting out with a bang.
Right, exactly. So no, I think everyone's going to love the segment with John. He's so personable, and being the head of market research for Marcus and Millichap, they just have such a plethora of information at their fingertips. And being able to tease out the things that we think our investors want is such a great thing that we can provide.
Yeah. And this is my first time interacting with John. I've never met him before, but he's been on Viking webinars with you.
Yeah, absolutely. We've done this before, and they're always great. What's cool about this one is in a week or so we get to meet him in person at NMHC. And for any of you out there that happen to be in Vegas or going to the conference, the entire Viking team, a big portion of the Viking team is going to be out there. Definitely reach out to us, and we'd love to meet you in person.
Yeah. Well, I think with that being said, we're going to go ahead and we're going to get right to the interview.
Absolutely. Let's do it.
We are super excited today because we have the lead expert for Marcus and Millichap. He is an industry expert. He's also a thought leader in everything economics and what you can expect for multifamily, macro trends, and micro trends this year. So please welcome John Chang.
Hey, thank you for having me.
Thank you so much for being here. I know you've worked with Chris in the past, but it's my honor to get to meet you myself. And Chris just told me a couple minutes ago that you're going to be at NMHC, which I'm also going to be at. So I hope I get to actually meet you in person.
Yeah, I'll be there the whole time. I'm actually on stage on, I think, Tuesday morning doing the markets overview. And then I'll be, of course, meeting with clients throughout the event. So hopefully we'll catch up, or maybe at our big client event party in the evening. I think that's Tuesday night.
Cool. Yeah, I'd be so excited. I know Chris will be there for sure, but I'm going to try to sneak my way in.
I'll find you an invite. Don't worry.
Oh, thank you. Well, we want to get started by asking you, I guess, probably what's on the forefront of most people's minds. So we have obviously a change in administration coming very soon. And with that change in administration, we want to know from your expertise, how do you feel about regulatory policies and changes coming and how they'll affect the multifamily industry?
Well, we're just going to grapple with the biggest challenge out there.
Start out with a bang.
Yeah, right. So policy is going to be a major issue in commercial real estate this year. And the spectrum of what we could see is enormous. So just, focusing on the campaign trail from the Trump administration, there was talk about tariffs. There was talk about immigration. There's talk about taxes. There's talk about, different policies related to regulation and deregulation. And all of those, any one of those could be have a major impact on commercial real estate. So it's really uncertain. So for example, if you look at tariffs are a huge potential issue depending on how they're implemented, when they're implemented, how severely they're created, whether there's reprisals from foreign countries when we put tariffs on them, do they put tariffs on us and our products? So that has a huge impact. If they're particularly significant tariffs, that could drive inflation. In 2017, I think it was 2017 or 2019, we put a series of tariffs on Canadian lumber, for example, and lumber prices shot through the roof, making development very expensive. So we're already facing a lot of headwinds in terms of multifamily construction. going forward. And tariffs could impact the cost of building new apartments, for example. It could also be very inflationary from a variety of standpoints, consumer goods and other things. And that's just one policy. If you look at immigration policy, for example, there's a lot of risks associated with that. During the previous Trump administration, we saw a significant decline in legal immigration to the United States. That affects housing demand, but it also dramatically affects agricultural production, healthcare, and also construction. About 35% of the labor force in the construction sector are non-native born US citizens. So if you see a downturn in immigration because of stringent immigration policies, that could slow down construction and other industries, but it's also can be inflationary if it drives a labor shortage. There's good evidence that we had over 2 million less people immigrate to the United States during Trump's previous administration, and that led into a labor shortage that resulted in dramatic wage growth. So there's a lot more going into it, but policy could really impact the performance of real estate, the supply of real estate, the supply of multifamily real estate specifically. And so that's something we need to monitor. And we don't have a lot of clarity on exactly how this will come together, that it could be very minor or not even come together at all. And so it's very difficult to plan for that. But on the flip side, for multifamily specifically, if we have a downturn in new supply, and we're already expecting that downturn to happen, then the performance of existing assets gets stronger because you don't have a new supply, but you still have continued demand. And we saw in 2024 really strong demand. And if that carries forward, then we could see vacancies come down in many markets. We could see increased rent growth, and that works as a positive for existing multifamily assets. So you started in with a big question. I gave you an extensive answer across a range of policies, but
you actually perfectly answered it, and you actually led me to my next question because that's
right.
Like it was perfectly stated. In today's economy, what's happening now, but then also what you're forecasting for the future, do you have a gut instinct, or do you not really have a preference and you think that it's better to just diversify on focusing on value add this year, new development, or what's your take?
Well, there could be some good deals emerging in new development, especially if you have a developer that got a little bit out over their skis. You could see some excellent assets come to market. Those are going to be few and far between, but and there will be a lot of competition for those properties. But we could see some of those trade. I think there's always opportunity for value add, and there's so many different ways you can create value. There's properties that are poorly managed. There are properties that just need to be refreshed and updated, some that need to be reconfigured altogether. So I still see a lot of opportunity in value add going forward, but we could see a lot of newer properties that come to market if an investor or a builder got a little too aggressive with their underwriting.
Chris, did you have anything on this?
No, I think the big thing that our investor base, another positive that people are hopeful for, and I don't think we have clear direction on what will happen or will get extended, but the idea of bonus depreciation and kind of some of the things that Trump instituted in the 2017 Jobs Act and how, from an investment perspective, a lot of those policies made investing into multifamily really tax advantageous. And it'll be really interesting to see if any of that carries over, if they're temporary or even permanent reauthorizations of some of those programs.
Yeah, the tax policy could be a big plus for investors. We have that bonus depreciation. And from what I'm hearing, it's pretty much a consensus that this will come together at some level. I don't know if any of them will be made permanent. They ran into problems trying to make them permanent last time, but they'll certainly be extended. And so if we see that, then those advantages come back into play, and it could create some unique opportunities as we go forward.
Yeah, absolutely. Speaking of strategies and unique opportunities, one of the things that people are looking for are strategic locations for their investments in 2025. So, looking at all of your analysis, I know that you guys have a huge, huge advantage with what you look at across the way, but we want to look to your expertise here. Are there any markets that people should be, maybe they don't know about or really looking out for 2025 investments?
Well, our advantages are your advantages, right? So, you have to remember that our research services team is a resource to investors. We're here to provide information and insight to try to help all of our investor clients make better informed decisions. In terms of markets, it really depends on the horizon you're speaking about, right? So, one of the surprising trends that emerged in the fourth quarter of 2024 was more rapid absorption than was expected. So we saw a lot more apartment units getting filled in the fourth quarter. Normally you see a cyclical slowdown in the fourth quarter, and it just didn't come, didn't show up this year. We typically would, expect a little bit of a pause in household formation, but I think it's accelerating. We've seen consumer sentiment accelerate, and that could drive more household formation. In terms of markets, a lot of the growth markets across the Southeast and the Southwest are doing very well, and they have really good long-term outlooks. I'm talking about Dallas, Fort Worth. I'm talking about Phoenix and Austin and parts of Florida. I think the Southeast Florida, Miami area has a really strong outlook over the short term. When you look at some of the northern markets that were not where the capital was deploying over the last few years, Ohio, Columbus, Cincinnati, Cleveland, Chicago, the upper Midwest, also the Northeast. We've seen outsized rent growth. I think Chicago was over 6% rent growth in the last year, which outpaces pretty much everything in the Sun Belt, right? You had as much as 8% rent growth in parts of the Ohio markets. So we look back and you say, well, what happened here is that there was just very little construction. And when the economy strengthened over the last year, as job creation has been very strong, especially in the fourth quarter, then you see a lot of that momentum transferring over into the multifamily demand. And that's everywhere in the country. But we didn't have that huge new supply surge in those northern markets that we saw in some of the southern markets. Now, investors need to be careful. They need to pick their market, their submarket. But a lot of those markets in the northern part of the country have outperformed, and they have the potential to do that over the next year to 2 years, depending on the economic growth. So it kind of depends on what how long you're looking forward. You're looking forward a couple, 2, 3 years. Those northern markets are looking fantastic. When you look out over 3 to 5 years or longer, then a lot of those Sunbelt markets are looking really strong because the wave of development is slowing down. The number of starts is dropped off a cliff over the last 6 months or so. So we anticipate that slowdown will work in favor of investors across the southern U.S.
Well, and when investors are looking at these submarkets, what type of metrics should they really be evaluating?
The number one thing that I encourage people to look at is what's happening with local employers. Okay. If you see growth in businesses in the local area, that's a real positive, element for that local market. That's probably the number one thing. The next thing I would look at is the in-migration, how many people are moving there, and how many of those people are young adults. If you have an influx of young adults moving into a market, they're more likely to be renters, they're more likely to move into an apartment, and that is a real positive trend. And we've seen that across most of the southern states. That's a big growth driver down there.
Yeah, absolutely. I would say one of the biggest things that we've noticed, because we are, very heavy in the Sun Belt region. So I would say we see a lot, like the population trends we have been watching are millennials and the Gen Zers. So how do you feel like their preferences are going to continue to impact multifamily demand this year?
It's interesting. First of all, there's been a lot of millennials who want to purchase a home, but the affordability of a home purchase is very low. The Only 27% of US households can afford to qualify for the mortgage on a median priced home. And that's about as low as we've ever seen. So home ownership is much more difficult today than it has been in the past. And that will be a key driver. When you look at millennials, they're getting married. The median age for marriage is 29. First time home purchase is now 38 years old. Just a couple of years ago, it was 32, and before that, it was in the 20s. So they're pushing back the formation of families, and they're also pushing back that first-time home purchase. And so right now, the bulk of the millennial generation, in their mid-30s, is still in the renter pool. Looking forward, the Gen Z population, which is now pushing up into their late 20s, is still very strong. You were getting about 4,400 Gen Zs turning 22 every day, right? So you have 4,000 new people who may be getting out in the workforce, getting their first home, getting their first apartment, and that's going to be a positive driver. I think during the pandemic, we saw a lot of people move out of the urban core. The millennials didn't really go back because they're into their 30s now. They're forming new households. They're forming, marriages and families. So that backfilling by Gen Z could be a real positive for the urban apartment demand across the country. We really saw a shift into the suburbs over the last 10 years, but we might see a little resurgence here from the Gen Zers going out and renting their first apartments in the urban core where there's much more of a live, work, play mentality. That does depend on the city, right? They're the ones who came out of the pandemic the slowest, the ones that were most cautious. Those types of cities haven't revived their urban core to the same level as some of the others. So it will vary by market, but I think that there's momentum that could be building for the urban multifamily demand.
Awesome. Are there any cities that you think are just absolutely the surge is coming and you expect to see it this year?
As far as the urban demand, I think we're going to see that actually in some of those northern markets, especially if their vacancy rates have come way down. So I think that we'll see more there. We've already seen it show up in, say, New York, for example, which has a great, 24-hour lifestyle city. And I think we'll see that down in the Southeast, down in, Miami area. I think some of these cities that have a stronger urban lifestyle. In terms of where that young adult population is going, we could see a lot of movement into Texas. Again, you see it going into Phoenix, and you see it. Salt Lake has a very young population. Salt Lake City is another market that I think is outstanding. It has a really young population, and multifamily has continued to strengthen and grow there over the last few years. Denver is another one. I think Las Vegas has great upside potential. There's been a strong migration there by the young adults into Las Vegas as well. So I think that there's a lot of markets, largely in the Sun Belt, where you're getting those young adults migrating in and taking a lot of those new jobs that are being created. And that's going to build those household formations that drive demand for multifamily.
Yeah, absolutely. Chris, do you have anything you want to add?
Yeah, I mean, listening to John's report, it's music to our ears, right? Because the last 3 deals we did, it's, Atlanta, Dallas, Austin. We're developing a deal in Phoenix currently. We're seeing the same things. It's almost like we're looking at the same data. And I think the only thing that I would kind of add that we're seeing, and I think you'll notice when you look at our portfolio, we're noticing that the tertiary markets in close proximity to these major centers, there's like huge value. And a lot of people are scared to go to those areas because it isn't technically Atlanta, it's Dawsonville. It isn't technically Austin, it's New Braunfels in between San Antonio and Austin. It's things like that where people are kind of scared off by the supply, but they didn't anticipate a lot of that supply getting absorbed. And I think that that's one of the areas where I think we've kind of navigated this right.
Those tertiary markets have been attracting more and more capital just because they offered a little bit higher yield. And because we did see stronger than expected growth over the last 5 years or so, A lot of those smaller areas have become very attractive, especially for people who are able to work remotely. They're a little bit out of the eye of the storm, if you will, and they have a very attractive quality of life. And I think that continues as we go forward. I think there's a lot more people living in those smaller cities than we've seen in the past. And I think that that has some sustainability. There's less new development in those cities, generally speaking. Of course, you always need to be cautious because somebody may decide to come in and put 400 new units into one of these small markets, and it's very disruptive. But there's, again, there's still a lot of opportunity out there. And I don't think that, especially the institutional investors, really don't want to be there. That's too outlying. And so you don't have that competition from the really big guys. And I think that's a real advantage for the small to mid-sized investors.
Yeah, absolutely. Yeah. So Chris, I know you have a couple of questions that you prepared that you wanted to ask.
Yeah, I mean, I think the biggest thing that I get asked every day, and I have, my thoughts on it, but I'd love to hear yours. And it's really the idea of kind of the Fed, what they're doing. People get so reactionary every time there's a meeting, every time there's new data that comes out. And I feel like a year ago, everyone was painting a picture that there were going to be massive rate cuts, and we saw some cuts. And now data's coming out that's a little stronger than expected. And the outlook for 2025 isn't as strong as it was 6 months ago. But if we felt that way about this data now, imagine if we felt that way 6 months ago when the data looked really strong and we were too cautious. That like in 3 months, it could be that they were wrong again, and there's going to be 4 rate cuts next year. I feel like it's so based off of human emotion to what's being said, and can we really trust the prognosis for what the Fed's going to do?
So when it comes to the investing climate, there's two parts of this, right? Which is, part of it is what the Fed will do, and part of it is how the market's interpreting that, and it's affecting the 10-year Treasury. And the 10-year Treasury is what a lot of the lending is based off of. So when you look at your rates on your financing going into an asset, it's much more based on the 10-year Treasury than the Fed. But let me try to piece this together. So we had super high inflation in 2022. It was climbing in 21 and peaked in 2022, and then it came down pretty quickly in 2023, and then it's kind of been trickling lower through 2024 and into this year. When you look at the metrics on inflation, they're in the high twos right now. And the thing that is concerning is that we've seen stronger than expected job creation in November and December. So the market's reacting to that, and the expectations of Fed rate cuts have been reduced. I think the election had an impact on policy, on Fed policy going into 2025. So if you rewind the clock, you go back to August, September, October, the expectations were based on a continuation of the existing administration and their policies, basically. The election was viewed as a toss-up, and a lot of the markets were really saying, okay, well, if it's something like what we've seen in the past, if we have a split Congress, if just Congress is split, we can expect things to be relatively stable. And then after the election, you look back, you have a Republican sweep, and the potential for change when the entire government is unified under one party or the other, it doesn't matter which. Anytime you have a unified government, there's more potential for change. That change creates uncertainty. And so the Federal Reserve is looking forward and saying, kind of going back to where we started the conversation, if you look at the risk potential to inflation from tariffs, from deregulation, from immigration policy, from reduced taxes, then you may be more cautious. And that's really being reflected here. We're already seeing pops in consumer sentiment, small business optimism that is fueling growth, quite frankly. We're seeing more job openings emerge. And that growth is already materializing before we see the new administration even sworn in. So as the Federal Reserve's looking at all this information, I have to guess that they're saying, okay, wait, let's slow things down. Let's be cautious here. So if you look at the press conferences following the Fed meetings, you had a 50 basis point cut in September. Then you had 25 in November, right after the election. And then in the December meeting, you had another 25, but the language changed. They said, hey, we may be at the point where we need to slow this down. We may have less rate cuts. We might not have any at all in 2025. And so they're signaling a transition in their policy from reducing rates to a much slower trend on reducing rates, and it's going to become data dependent. So when we get CPI numbers, when we get core PCE numbers, personal consumption expenditures, which is the key metric used by the Fed, if those inflationary numbers start to move up, then you can pretty much bet the Fed is going to hold steady. Depending on how much they move, they may even raise rates. So right now, the expectation is that we'll have 2 cuts in 2025 with, and this has literally been moving day by day, even hour by hour over the last week or two. But right now, the expectation is 1 rate cut in June and 1 in the second half of the year, but it's not locked in, of course. So when you look at that and you say, okay, every time we get a really positive economic growth number, right? Economic growth is good for apartment demand.
Yeah.
But it's bad for interest rates, right? So we're in that world we were living in for years. And so as we get these new numbers coming in, if they're saying, hey, the economy is going to grow and it's going to grow more quickly, which is what deregulation and some of these other policies are designed to do, then we could see higher inflation and the Fed's less likely to reduce rates. Wall Street knows that. And so whenever we see one of these really positive numbers, like the December jobs number that came out a little bit ago, that was much higher than expected. We added 256,000 jobs. The Fed wants to see something south of 150. And so that really strong jobs number kicked the 10-year treasury and it pushed it up 10, 20 basis points. It's, right now it's about 4.8. And so we may see a much higher interest rate climate over the course of 2025 than we were hoping for. Flip side, we'll probably have more growth than we were expecting. So there's a trade-off there.
Yeah, and I think, I think the quote I got was actually from one of your podcasts, and I use it when I talk to investors. It really resonated with me. But you kind of compared the Fed steering the Treasury to kind of steering a ship. And you're like, it's going to make these gradual turns, knowing that it doesn't fully have control of the ship, that it has to kind of see how it's going to land and then reverse course. And it's very delicate. It's a delicate balance. But what I try to impart onto our investor base is that if interest rates go up, it's neither good nor bad, right? It's going to affect things in a certain way. And I've always been a contrarian and said, if interest rates are high and cap rates are expanding and people that need to sell are selling, this is an incredible buying opportunity if you're willing to take the risk. And inversely, like if you had what you're hoping for, where interest rates go back down, way down, you have this run and a lot of people are putting capitals in, capital compresses, you get to a point where it doesn't make sense to buy deals anymore. So you really want it to kind of be in that middle area in order to consistently have an equilibrium where you can operate all weather.
You're spot on. And cap rates have gone up 100, 150 basis points, depending on where you're looking, which property type and, which markets. But, historically speaking, if you go all the way back to, say, 1990, cap rates have only gone up a couple of times. All right. And every time, if you look back and you look at those times when those cap rates went up, almost every investor I know goes, man, I should have bought more when the cap rates were up at, 5.5%, 6%. And that's a rare trend. And so the challenge is the math today, right? The going in rates,
really the yield,
the cost of capital going in, that spread between what you're borrowing at and the yield you're getting is actually probably negative in many cases right now. And most investors are not really excited about having a negative yield going in on their leveraged yield. So that makes it very challenging over the short term.
Yeah, I mean the metric that we focus on, I think, during this time, and I think I heard your CEO at Marcus Millichap mention it too in one of his talks, is replacement cost. And when you see replacement cost much below, what it would cost to build the property today, and you're still looking at a flight to quality type asset that's a few years old, it seems like a no-brainer.
Yeah, we're going to be below replacement costs. I mean, the prices are well below replacement costs, and they're not going to get it. The replacement costs are not going to get cheaper. I would argue that the replacement costs over the next 2 years are going to increase dramatically, and I think the pricing is pretty stable right now. And the thing is that when you look at the long-term demand drivers, they're extremely powerful. And especially if you target markets where you see good job creation, those long-term drivers are going to far surpass the supply additions in most of these major metros with strong growth. And so the builders simply cannot add inventory right now. Their cost of capital is too high. Their cost of labor is too high. Their cost of materials is too high. And it's going to take probably the better part of 2 years before they can prime the pump again. So we're looking at 3-4 years before we could even possibly start to see a significant wave of development come back into the market. In the meantime, your performance metrics, your vacancy rates, your rent growth get stronger over that entire span. And again, you locked in pricing when cap rates are elevated on one of those few incidents where they actually climb. And so this could be a unique investment opportunity, especially when we reflect on it 5 years from now. Pretty much everybody who's been sitting on the sidelines during this cycle may go back and go, wow, gee, we missed that opportunity.
Yeah. John, thank you so much for your time. I want to end there because I think your advice to investors is so spot on. And I know our listeners especially are going to be so grateful for this episode. So thank you for your time. I hope that you'd be willing to come back maybe towards the end of the year and we can see how much of this has transpired and how much of this has changed.
Well, I'd love to come back. We love working with you guys and you've been a great partner. And so happy to come back anytime.
Wonderful. Thank you so much. And I hope to get to see you very soon.
Yep. I'll see you at NMHC.
Yes, thank you. We really hope you enjoyed today's show and our interview with John Chang. We want to have a huge shout out and thank you for joining us and sparing us your time. We know your time is valuable. And to all of our listeners, thank you so much for listening in this week. We're very excited for next week's episode as well, and we appreciate you. Please make sure you like and follow us for more. Have a great rest of your day. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.